Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Josh Schwartz of Growth Factors and Bregal Sagemount. And what's really interesting about the conversation with Josh is that Growth Factors is almost like a captive operating partner for Sagemount, and they work on a ton of their portfolio companies, and they don't work with any other private equity investors. And so Josh and I talked about their approach to value creation, how they look to find levers, how they navigate the political dynamics inside companies, and even the people side of transactions and integrations and transformations. And I think a lot of PE investors that are thinking about building an operating team or how to leverage operating partners to create more enterprise value can learn a lot from it. And then the other thing that I really found interesting is we talked about this concept of trying to grow businesses and being more aggressive with the cash that you have on hand. And I particularly think that that's something that PE firms and founders can take a lot away from. So with that said, I'll leave you to it. Enjoy the episode. All right, Josh, welcome to the show. How's it going?
Hey, doing good, man. It's been a crazy week. I've got a 7-month-old teething baby who's kept me and my wife up all week. So teething led to cold led to ear infection. So I'm saying 100% on my game today, but this should be good though. Yeah,
that is. I've been there.
Yeah,
very different start to a podcast than usual. So I'm sure there's people listening with young kids that totally identify with that.
Yeah, for sure. Or if not, in the future,
Yeah, or in the future, exactly. Yeah. So, with that, why don't you introduce yourself? Like, what do you guys do at Growth Factors in your role, and we'll take it from there.
Yeah, sure. So, my name is Josh Schwartz. I lead the go-to-market strategy team at Growth Factors, which is the operations arm for Bregal Investments, which there's about 6 different private equity funds globally, but most the fund that we work with the most is Bregal Sagemount, based out of New York City, raised about $7.5 billion over the past 10 years. Most recent fund, $2.5 billion for flagship, another $500 million for a small cap fund. We also have a credit fund inside of there as well. They both kind of as like flexible capital for all types of scenarios. And my job as a go-to-market leader on the operations team is to help our portfolio companies, realize those investments as fast as we can. We're trying to always increase the MOIC, the IRR, help remove obstacles, miss the hurdles, give good advice, help with anything that we can, to make that investment better, shorter, faster. Is a good way to put it.
And in terms of your role, like you mentioned Sagemount and then you mentioned Growth Factors, like walk us through that. Like, how do these two practices connect with each other and relate?
Yeah. So from Bregal Sagemount standpoint, I think the easiest way to put it is that we've named our value creation team, our operations team, Growth Factors. Yeah. And then from a legal standpoint, there's other stuff, that we don't really have to get too deep into. But what it does allow us to do as well is work with some of those other funds. Because in the value creation team, typically what you'd see is that they're paid by management fees, right? So that typically mean you can only work with one fund. But what we've been able to do is work with Bregal Sagemount, Bregal Sphere, which is our impact investing fund, BU, which is our fund based out of Switzerland, and some of the other ones as well.
So in effect, you have taken the operating partner or operating side of a PE firm, and it operates almost like a separate consulting or value creation team that has its own P&L that's separate from the private equity.
Yeah.
Is that the best way to describe it? Because most PE firms actually have that embedded, and it creates a bit of a conflict or trade-off at all times.
Yeah, I would say either way, you're going to create some sort of conflict, right? Because, in the end, what you really want to do is have incentives that are the same for everyone. We're all driving towards the same outcome, which is a great exit, right? So that's for everyone involved there. And, we have our reasons to do that, which is like typically when we do good work and do good business, people want to work with us more. And then, if you're connected to the fund, a lot of times the way that you're paid to that is through carry or other things, right? So it's all connected. Yeah. But there's pros and cons for both ways to do it.
And walk me through the model a little bit. So like Bregal Sagemount acquires a company.
Yeah.
When are they bringing you in? What are some capabilities you bring to the table from the growth factor side? What are some core levers or pillars you focus on?
Yeah. Yeah. Thanks. So when do they bring us in was your first question. So a lot of times now we're jumping in pre-deal. So before it's closed, usually around the LOI. Once we've got like a pretty good deal in hand, makes sense to start getting us involved to talk to the management at the business, mostly to try to determine, do we want to work together? Yeah. They need to like understand our model and determine like, hey, yeah, do we want like something that's not necessarily this heavy handed, but like has a lot of support, I think is a good way to put it. Right. Not everybody wants that. Some people just want the cash, leave us alone. That's okay. Right. I think our model is, a lot more, hey, we have these people here to help you. Right. And if you need that, but we're going to get them involved early. So to answer your question directly, Shiv, we're getting involved before the deal gets closed, helping to understand like the evaluation of the business, giving our opinion on the operators at that business and how we should evaluate it. Right. Because a lot of times when you're either going to bid up or down in a competitive process is depending upon what you believe the evaluation is and what's the opportunity at the business, right? I mean, bidding at 19, 20 times EBITDA is different than 22, 23. And, like we got to decide, what we want to do. Yeah.
And how are you figuring that out pre-deal, I guess? Like, for example, on our side, we work with a ton of private equity firms and we'll do marketing due diligence. So we're helping them understand what is the potential on the marketing side and looking at the opportunities and adjusting budgets and things like that. So what is your approach? What are some of the levers that you're focused on?
Yeah, I mean, there's a lot of different things, but I'd say like in general, a lot of it comes down to the same thing. It's like, how do you get more leads? How do you convert more of them? Or how do you maintain and keep more revenue? Right. So a lot of times when you get into a business like this at the size that we're working with, which let's just say like normal investment for us, the company's somewhere between like $30 to $50 million in recurring revenue. Now they've also probably been around for 10 to 20 years. So they also usually have like really great products, but maybe they could use some help on the go-to-market side. So that's like a really good fit from us. So just like you said, right? Like we can come in and audit the website. We can audit, SEO. We can take a look at win rate numbers. We can listen to recorded calls. We can talk to the team to understand where are they at with their pricing and packaging strategy. Is there something from a discounting, percentage or levers that we could pull off, right? Is the account management team maybe underdeveloped, at the moment, or they haven't focused or prioritized, upsell and cross sell in the past? So to answer your question, we kind of go across the spectrum from, looking at marketing, new logo sales, account management, customer success, and also into like the pricing and packaging world to help us determine how powerful we think those levers are. And then really, I guess, what's the ease of getting them done? Yeah, because like, I mean, maybe, like implementing Salesforce, for example, isn't going to be something that you do overnight, right? But, potentially, turning on, a channel could, if we already have a relationship there. Or, going out and hiring our first few people in account management when it's never been done before. And those types of things can have an impact. Yeah.
How do you figure out, like, what's your methodology for figuring out what to prioritize? Because value creation plans, you can, throw the kitchen sink at it. You can do account management, you can do debt near, you can do cross-sell. So how are you prioritizing between all of those avenues?
Oh my gosh. Yeah, I think it's really important to understand, how we even approach value creation. And for us, it's, kind of taking a look at it. We call it like pillar by pillar, office by, office of the CFO, office of the CRO, office of the CMO. That's pretty normal, I suppose. But taking a like a tiered approach where we want to look at data, interview people at the business, and kind of bounce back and forth between those two things and work together to really determine what that is. Because, I mean, let's be honest, like a lot of consultants and people like me, we walk into a business, we think we know everything, but really the people that know the stuff have been working at the business for a long time. They are in the day-to-day. They understand the business, right? So we have to make sure that we talk with them, we interview them, we really understand where they think the opportunity is. And that helps us lead us in a good direction. I mean, I literally say I interview hundreds of these people at these portfolio companies, and they're all the smart ones. And I literally tell them, listen, I have no good ideas. You have all the good ideas. What my job is to collect them, make sense of them, and then put a value to them, right? So put a calculation to it, right? If I'm going to drive more leads, how are they going to convert down the funnel? What does that mean for enterprise value? What's the impact of that? And to answer your question directly, Shiv, that's where we determine if it's worthwhile doing or not, is the enterprise value impact of it, and then the difficulty, right? Because if it's high enterprise value impact in a short period of time, that's something we got to do, right? And also if we have the people at the business telling us like, hey, you got to do this, that's something that we got to do.
Forgive me, I'm still trying to wrap my head around this process. Because I understand, let's say, the dynamic of our relationship, because with PE investors, because we'll come in, we'll make the recommendation, and then ultimately it's the board's decision to decide what to do. In this case, you are growth factors, you're partnering with Bregal Sagemount, and then are you captive to them? Like, are they the only PE firm you're working with? And then what happens with your recommendations? Are they then building their own value creation plan using your recommendations, or are you involved in the value creation process? Like, help me understand that distinction.
Yeah. I think a lot of times that's the difference between consulting and working in private equity is how serious are your recommendations taken? And then also the back end of it. What is your role in implementing those things and project managing those things and making sure that they happen? Right. So that's, I think, the big part about my job is not just going in and finding it and saying like, hey, this could be cool, go do this. Is that we also have to help them on the implementation aspect, the project management aspect, and take a role inside of that sometimes. Right. So, just looking at the size of the business, sometimes like we have to actually step in and get our hands dirty. Right. I was just telling you guys, like, just this morning, running a cold calling, workshop for one of our portfolio companies, doing the same thing, tomorrow. It's for a reason. It's because, we recommended, or in some way, someone has recommended, hey, we need to build this team that does this, that gets more meetings, that generates more business. And, there's somebody in the business that can do a good job, but maybe doesn't have as much experience as someone like myself that's been doing it for, quite a long time. Right. So that's where a lot of that value comes in, right? It's like, we're not just saying, hey, go do this, but also, stepping in and helping when necessary.
And I guess when you're coming in and you're getting involved, and like even the part that I was questioning on the connection with Bregal, like, are you guys captive to them, or are you working with other PE firms as well?
Yeah. So we're just working with, so like, if you look at the structure, there's Bregal Investments. Now underneath of Bregal Investments, there's a bunch of different private equity funds. There's like 6. We are captive to them.
To that. Okay. I understand. So in a way, they've kind of just outsourced it and you're kind of running it. I understand that. And I totally get the need for project management and implementation and execution. Talk about the work that you then have to do on the people side, because there's the value creation work.
Yeah.
When I've experienced this, especially when we come in, like we get in there and we're partnering with the CMO or CEO, and sometimes it's perceived as a threat and other times it's perceived as a partnership.
Yeah.
Talk about how you go about navigating that.
Yeah. Oh my gosh, that's a great question. Typically, this is my advice to, management teams. And we get asked this question all the time, right? It's like, hey, how good do you think so-and-so leader is, or whatever, right? I just tell them, like, look, the best leaders are not worried about us coming in and getting them kicked out of their role or whatever. Okay. It's the people that typically are not open with themselves or are scared that we're going to displace them. That's where we have issues, right? So that also tells you something about their capabilities and ability, because somebody who is really self-aware understands that, like, hey, these people are here to help. We make that very clear. Yeah. So we can almost sometimes like evaluate, how good that leader is in that category based off of how threatened they feel by somebody like me. Because, hey, we're here to help, and all the arms and elbows that you can get, you should take it. right? So we see really smart people take it like that. Yeah. Hopefully that answers your question, or if you have
Yeah,
a follow
it
up.
does.
Yeah.
Yeah, I mean,
Yeah.
I've experienced the same thing. I found that
Yeah. Yeah.
the best leaders, CEOs, marketing leaders, revenue leaders are
Yeah.
open to getting as much help as possible and have an open mind. Uh,
Yeah. Exactly.
where we run into problems is when people feel like they're doing a good enough job, and then 6 months later they miss revenue targets, and then they had told the board that they don't really need help.
Sure.
And I think that's kind of where you end up in, like, pie in your face kind of moment. And a
Yeah.
lot, you'd be
Sure.
like, it's a lot of people that operate that way where they don't want the help. It's like a territorial thing. It's like
Absolutely.
that's their fiefdom.
Yeah. I mean, I've had it happen a couple times, and don't get me wrong, I think that it's for a purpose. But usually as we dig in, there's something that we find that just like isn't right. You know, that could be data, that could be leadership style, it could be a lot of things. But yeah, I think the people aspect is really, really interesting because it's a change management process. That's really what it is. So like moving the leaders aside and like talking about like, hey, how do you implement change, at a business, or, like massive, like we're talking like big change sometimes, right? We'll say, Shiv, like, hey, this company grew at 10% per year for the last 10 years. And we're like, okay, cool. Well, we're going to double or triple that. We're going to grow by 20% or 30% for the next 3-4 years. And like, that's different, right? Or they could be in like startup mode, and we're like, or like, hey, this is a family run business mode. And once we come in, that's not the expectation anymore, right? We need metrics. We expect updates. There's, different expectations from leaders. Yeah. So there's definitely a change management process that goes on there, right? And I think like, honestly, the best way to do that is to bring them along, through your thinking, right? Make sure that you're over communicating with them, as in just like, for example, hey, I found this, I was going through the data. I found this, instead of making an assumption or like something like that, just be like, hey, like, what does this tell you? Right. And actually like show them that information and walk them through it. And like, we'll actually probably get to the better answer together anyways. And when somebody feels ownership in the process and, feels like they've been heard, that changes the dynamic of the change, right? Because a lot of times these are things that they're suggesting or that we want to bring to them that are like now their ideas, not ours. I think that's a really important piece, like around what we do or in servant leadership or in consulting in general, is like, you're not the hero. Okay. I'm not the hero. The people of the business are the hero, and they truly are, because those people are doing it every single day, and they have to go do a lot of the hard work, and they have to listen to me, which is probably not good anyways. Right.
Right.
So honestly, they're the heroes. Like somebody like me that's just like, pointing stuff out and trying to be helpful, but they got to do the work. So we might as well empower them to do their best work.
Yeah, that's the other thing I find is that inside companies, especially ones where it's clear that help is needed, the middle management or like more junior folks actually want mentorship and direction and want guidance from people who have been there and done that. And they also can see the signals of things that are not working or strategies that they've implemented that aren't generating a return that they want.
They're feeling that pain every single day.
And they're feeling the pressure of having to deliver on something and missing it, and then feeling accountable to everybody and worrying about their jobs and all that kind of stuff. So there's a bunch of other dynamics, and I think it's more the leadership where the resistance is there. I've even seen it with CEOs, like especially founders. Like founders can build a great business and then exit it. Now there's a professional board and there's pressure, different expectations for reporting, and you're not used to having so many cooks in the kitchen. You're used to just leading it yourself, and there's like an identity crisis at play there, and that makes it harder too, because it's like that person needs to level up into becoming a professional organization CEO, not just a startup or like founder-led business.
Sure. Yeah.
It's a big, I think that's a big gap. And I think especially as people like you or our business, like we come in, I think it's about finding the right type of partners internally that can actually execute on some of those things. And I think by the end of it, you end up having a major transformation, but to kind of make that transformation, you have to navigate people and the politics and all of that stuff as well.
Well, let's go back to like when you said, hey, when do you get involved? Right. And I was saying, it's so important to get to know the management team, and both sides are trying to decide if we want to work together. that is a huge part if we want to work with someone, right? Is this CEO? Is this CRO? Is their leadership team? Are they going to come along with us? And also, how open are they to this stuff? I mean, I can tell you, like, we've done a lot of investments over the years, and the ones that work out the best are those ones. And it's not because we give the best advice. It's because they're open to it. They're open to change, right? There's less resistance, and it takes less time to make change happen, right? Because all the resistance typically does is, to your point, is 6 months later down the road, we miss the number. And we're like, okay, what now? Okay, now we're open to the change, right? But now we wasted 6 months. And, typically our hold times are somewhere between 3 to 5 years. I think most recently it was like 3.3 is average exit. And when you waste 6 months, you just extended, the whole period. Yeah. And your IRR just dropped. So,
Totally.
And there's other, a lot of times there's structure in the deal that you could have got hurt on, all kinds of things. So in general, I'd say what we're looking for during that, management interviews and, talking to businesses is like, it's the EQ, the IQ, it's the self-awareness aspect, founders and leaders in the business.
Yeah. I think sometimes it's also like, I think, we talk about growth and value creation and all these different things. And, I think one of the most understated elements of an effective value creation plan is actually consistently executing on it. And then just having a plan that the whole organization can rally around. It's clear who's responsible for what. It's clear what initiatives you're moving forward. And if you consistently move the ball forward, like one way or another, you're going to create enterprise value. But what ends up happening is, like, in companies, you have one idea that gets 3 months, and then before you know, you shifted to something else. And there's multiple people who have different versions. And so you end up creating
the shiny object.
Yeah. You don't, and so you really need true buy-in from everybody. So I think it's more about that. It's like, can everybody operate as a team? And even if you disagree, you kind of talk about it, and then finally you commit to the decision, you kind of move forward. And I think that as a cultural tenet ends up making much more progress.
Yeah. Couldn't agree more, man. That's a good way to put it.
Yeah.
Beautiful.
So talk about, like, what are some of, like, now that we get into, like, the actual work itself, like, as you close the deal and you're brought in and you've vetted the deal and you built a plan, like, what are the areas that you're focusing on post close?
Yeah. So on the go-to-market side, I was saying earlier that those are, how to drive value through, it's like the marketing, sales, account management, pricing, and packaging are the big things. So if you think about, how that applies to, like, bigger terms, like especially in software, it's like get more, close more, keep more, like I was saying earlier. Yeah.
Got it. And like when you're looking at those avenues, and, like, obviously go to market is a priority, but what are some of the other major areas that you're kind of looking at?
Yeah. So in totality at Growth Factors, we also have other pillars outside of go to market and pricing and packaging. So we also do as a service M&A. So it's inorganic growth. We're also doing talent or recruiting as a service. So we've hired hundreds of people every year back into our portfolio companies, anywhere from C-level executives down to entry-level salespeople. So I actually spent a lot of time, or historically have spent a lot of time there as well. And we also do some things on like culture and DEI and things like that. So, but I'd say biggest things that you'll see, are go-to-market, pricing and packaging, recruiting, and M&A.
Yeah, and one of the things that you had said is, like, 70 to 80% of the value built at exit is through go-to-market. Can you expand on that a bit?
Yeah, we did a study a few years ago, and you can do, like, an enterprise value calculation in the end, and where does it come from? And a lot of times, if you just understand how a company is evaluated, it's it's an EBITDA number, a growth percentage, right? And there's some sort of magic number of people talk about, like, the rule of 40 a lot, right? So just as for example, but like 20% EBITDA and 20% growth, that's interesting. But here's the scenario. Okay. If I have 50% EBITDA and 10% growth, what should I try to do? Like, should I go down to 40% EBITDA to get 20% growth? Or, like, what's the right mix?
Mm-hmm.
And to be honest, in the market, there's a correct evaluation there. You'll see the multiples expand at certain levers of that, because they're basically saying, like, for example, hey, your EBITDA is too high, your growth is too low. it'd be better to actually spend that money, because $1 in the bank is valued at 1, but a dollar of recurring revenue could be valued at 10, 15x that, whatever.
Completely agree. Yeah.
Yeah. So back to the point is like, a lot of times it's where to spend it, and that's where what we're trying to do, right? And I think you hear this in the market today, right? It's like, spend your money the right way. The days of just burning cash are over, right? Efficient go to market. So I think a lot of times in our plans, what you'll see is it's okay to do that, to burn some cash or to honestly burn cash, but like drop EBITDA down below where we got it in the first couple of years. Because what you're really trying to do is cause a J curve inflection on growth. And, you got to try stuff. You got to make investments into growth, to get the flywheel going. So that's, I guess, the point is trying to find the right balance between those two things, between EBITDA in the business and growth rate, and doing it in an efficient way. And that's where I think a lot of that go-to-market, value comes from, at our exits, is like fine-tuning that, right? Deciding where to do it, finding where there's inefficiencies in the process or revenue leakage, filling those gaps, and I guess like the small knob turns along the way. Yeah, I can give you a lot of examples of the knob turns.
Yeah,
for sure.
Yeah. I think that the point about $1 in the bank is worth just $1 on exit.
Yeah.
Whereas if you have $1 of recurring revenue, it's worth 7, 10, 15, even 20x, depending on the type of business that we're talking about on exit. It's such a great point. I think that's one of the things that we try to preach is also that just, if for example, you have great LTV to CAC ratios or great CAC payback periods, you can be more aggressive because that money is going to find its way back to you. We find that a lot of companies, like we once had a client that had $200 million in cash in the bank, and it
sounds like Apple. Yeah,
it was a large business.
Yeah,
but nice. It's a ton of cash for a company of their size, and they were not a public company yet, and so
oh my gosh, yeah, you're sitting on a gold mine.
Yeah, and I think a lot of companies may not look like that exactly, but they do have like EBITDA where it's 30, 40, 50%. And the growth rate can definitely be inched up. But I think especially if you're owned by private equity, you're kind of more hesitant to deploy that because you're hitting your rule of 40. It's a healthy business, and you're why get more aggressive when you can have a good exit on that?
It depends on your comp plan too, man. Like, let's be honest. Like a lot of these executives, it's like, hey, there's an EBITDA target or whatever, right? But there's a balance there too, because if you have ownership in the business on the back end, you're going to make some money, on trying to hit like the right mix between those two things, right? So
incentives need to be changed. Like you can build a healthier business if those incentives are more aligned, right? Like, I mean, even
exactly.
I've bootstrapped this company. I don't have any investors, but I'm often making this trade-off between being an EBITDA focused company versus investing in really big ideas. Like this year, we're building our own software. We're launching our own training program. We have a bunch of things ongoing, and that takes cash and capital up front. Would normally just be pure EBITDA for us, right? But we have to make that conscious decision to kind of get to the next level.
Well, I'll just give you an example. Like somebody had asked me this. I was speaking at some sort of like Salesforce panel a few months ago, and it was like a PE focused one, and there's a bunch of CEOs in the room, and they were asking like, hey, like, what about EBITDA? Should I spend this money? Right? And like, just to your point. And my advice to them was very simple. It was like, look, do you plan on exiting soon? No? Okay. Listen here, right? Because you've got time then. So I think that's the other component here is to think about is like, yeah, it's great to have a ton of EBITDA when you're preparing to exit. Yeah. But if you're like, hey, I got 3 years, I got 4 years, I got 5 years, it's time to, I'm not saying burn the cash down to zero, right? Like that. But like, it's okay to drive that number down a bit, to go look for growth. Yeah. Or to, like, we call it like green shoots. Yeah. If you can show, a new market a new product, a new vertical, whatever those things are, the next buyer is going to really love that. They're going to evaluate that and they're going to see it as an opportunity as well, right? Something that they didn't have to go do, I guess is a good point. And it's already been tested in some ways. Yeah. So we love that.
Yeah. I mean, even just for founders that are listening, like one of the things that I think about is, as a founder, your business holds a ton of your net worth, whether it's, or each founder, the answer is different. But the point is, like, when you have EBITDA and you issue dividends to yourself, like, you have to put that money in some sort of an asset. If you just leave it in a bank account, you're making a mistake. But, whether you put it in the market, whether you put it in real estate, like, you're putting it in some sort of an asset. And that asset that you put it into, like, you would be lucky to get 20% return on.
Yeah.
You'd be lucky to get 15%.
7, 10.
And
yeah.
Exactly. Right. So I had a PE investor once tell me, like, if you're doubling your money every 5 years, you're doing great. Right. And
absolutely.
And that's the 16% growth, right? Something along those lines. So I think if you think about it in those terms, it's like, well, what is the best investment that you can make on that capital that you would be taking out as dividends, or it's to reinvest it in something, right? And what is that reinvestment? Like, as long as you have strategic levers inside the business that you can scale up, whether it's go to market, new products, new channels, new opportunities, new supply chain areas, whatever it is, like as you invest M&A, right? As you invest that will pay way more than whatever you would get it from a different asset class.
Yeah, that's the calculated bets, and like that is the value creation plan aspect, right? Like that is the whole idea behind that, right? Is like, let's figure out where are the levers, let's figure out how much it's going to cost us to go do that, and then what's the return, what's the potential return, what do we think that enterprise value return in X time periods is going to be. That's what that whole thing is about, right? So I think that's if you're talking to the founders, if founders are listening, you have a really good operating team or really good partners when they can kind of explain that to you, right? Like, they're like, yeah, we think that we should do this, but why?
Right.
Why?
Right.
Because it's like, to your point, it's your money.
Right.
If they can explain it to you, like in those terms, like, hey, if we do this, it's going to increase your enterprise value by X. That's like a much easier way it's a palatable, right? Way to spend money, right? Because then you're seeing the impact or the return. Because you're like, ooh, if I give you guys, $1 million, I'm going to get back potentially 10, and at the low end 7. Like, let's go.
Totally. Yeah, and I think that's a trade-off that more companies, and I think PE investors in general, do think about these kinds of things, and that's why they think about putting debt on the business or putting money into M&A, stuff like that. But I think on the go-to-market side, I find that there can be more aggression, especially when you have your net revenue retention dialed in, you have great CAC payback periods, great LTV to CAC rates, like some of these core business metrics that are in a better place. We see, like, if you use it as a benchmark, like 10 to 15% of your revenue should be going to sales and marketing spend at the very least.
Sure.
A lot of companies are underinvested there. So that's an opportunity immediately to spend more.
Yeah. That's definitely a piece, right? When we walk in, we're trying to figure out where the budgets are being spent.
Right.
And, is there opportunity there? But
right.
Yeah. I mean, there's so many amazing companies out there. Mm-hmm. Let's be honest. There's so many amazing companies out there that have been product led, founder led, have found most of their sales through word of mouth or inbound or RFPs, and they've got to a really good spot and they're comfortable.
Right.
Yeah.
Totally.
And then you're like, okay, this is going good. Right. But usually what happens, there's a window, right? There's some sort of window that opens up, right? For example, there was one of the companies I'm working with, their biggest competitor was like, hey, we're actually going to we're end of lifing our product. Yeah. Oh, okay. And they sent out a message to all of the users, all the companies that were using it, like, hey, we're end of lifing our product. Well, that freaked a lot of them out, right? And so now their competition's like, ooh, we have a window of opportunity, right? Like, let's take advantage of this. So what did we have to do? We had to say, okay, we're going to make investments in sales. We're going to make investment in marketing. We're going to use technographics to go and target those people. We're going to learn who every single one of them is, and we're going to bring them over to us, right? But that's a calculated, risk based off of a window of opportunity. And it's a really easy example too, right? But there's all kinds of examples like that you could say, well, hey, we have this small window. We've got 3 to 5 years to go do this before a bunch of other people come and do it. and we got to capture the market.
Yes, totally agree. Totally agree. I know we're coming up on time, so I want to just talk about one last thing before we wrap up. Is one of the interesting things about your role, growth factors, and the arrangement you have with Bregal Sagemount is the model and how it's structured. So, what advice would you have for PE firms that are trying to explore this, trying to figure out how to leverage operating partners or how to make sure that they don't overspend on overhead at the same time are supporting their portfolio companies?
Yeah, it's definitely like, something we're seeing more and more, right? Is it more funds or creating operating teams? They're trying to leverage, experts in different ways. They think that they can do a few things with them. Number one, helps close deals, which is great. Number two, who's helping operate the business. And I say this, and here's probably the downfall is that if you have the finance guy that's never, been a CEO, never been a CRO, whatever, really guiding those businesses, that the advice that they can give can be hurtful. Yeah. Because they're looking at it from an investment standpoint. Right. So I think, to answer your question more directly, that is the spot. Yeah. Where, founders, where management teams are looking for guidance and looking for help. They're looking for people that have been in their shoes in the past. Right. And that can help guide them. And a lot of times, that's the value that they bring, is that instead of giving, advice that could be destructible or bad, they're giving them advice that's like, hey, I've been there, done that. Here's what happened to me. Right. Let's go a different way. All right. So if you're going to build an operating team, look for those people and maybe understand the private equity side or have had some sort of touch to it.
Mm-hmm.
And then look at your portfolio and say, what do these people need? And try to make a match there.
Yeah.
Right. I think that's definitely the big piece.
Yeah, that's great advice. I think it's people that have been there, that understand it, that are operators, that have that experience. I think a lot of PE firms need to provide that. So great advice. And with that said, Josh, what's the best way for people to get a hold of you if they want to get in touch or learn more about what you guys are up to?
LinkedIn's always good. Yeah. So you can find me. My name is Josh Schwartz on LinkedIn. It's like Josh Schwartz STL because I'm from St. Louis.
Awesome.
That's it. Yeah.
Yeah.
So
Awesome. Yeah. And we'll be sure to include that in the show notes. And with that said, Josh, thanks for coming on and sharing your expertise. I think great conversation. And I think a lot of PE firms that think about value creation and how to prioritize things and also just building their own operating teams can take a lot away from it. So appreciate you doing this.
Thanks, man. Cool. I'll talk to you soon.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.hadasas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.